Welcome to our first video for financial statement analysis. And in this video, we'll cover the statement of cash flows. You might be wondering why we need to talk about the statement of cash flows when we spend so much time in so many of the accounting courses focused on GAAP and accrual accounting rules, revenue recognition and expense recognition. You probably are familiar with some of the time that we spent in intermediate talking about revenue and expense recognition throughout every class across those 2 semesters. So why the statement of cash flows? One reason why we need to understand the statement of cash flows is it answers important questions, similar to those questions that come up in any relationship with a significant other. From my experience, questions like, oh, you bought more speakers. Didn't know we needed more speakers. Don't we have enough speakers in the house? And oh, you bought another road bike. Where are we going to put it? We already have 3 road bikes in the garage. What are you thinking we're going to do with that one? For companies, we're wondering, how did you spend that money? Are you spending money in ways that's going to produce future revenues and future income? A second reason is liquidity. We want to make sure that companies are able to pay their bills, because if they're not able to pay their bills on time, eventually they're going to go into bankruptcy. And 3, the other thing we can get from the statement of cash flows is a little information about the quality of earnings. How well do those cash from operations and your cash flows overall match net income? Because net income, while it's an extremely important metric, and earnings per share, which uses net income, might be the most important metric used by investors, you can't pay your bills and you can't run your business with revenues or income. You have to pay your bills with cash. And so the statement of cash flow tells us a bit about how is cash being spent, where is the cash coming from, and what is the change in cash over that accounting period. So we're not going to do what you've done in previous classes, which is prepare a statement of cash flows. We're going to start analyzing the statement of cash flows. So in this video, we're going to take a look at a few 10Ks, their statement of cash flows. We are also going to look at cash flows as they change for particular companies over time using some data. And we're also going to look at relationships between cash flows and other metrics over time. Let's start with a quick review of the 3 classifications on the statement of cash flows. Let's separate this into 2 columns. One for the cash received, or cash provided by, and then we'll fill in each one of these classifications. This is also known as sources of cash. And on the other side, we're going to have the cash outflows, or cash payments for. We're going to fill in the various items according to the 3 classifications. And the cash outflows or payments for are also known as uses of cash. Okay, so the first type we're going to look at is operating, cash from operating activities. And the main way that we're going to receive cash from operating is, of course, from customers. And another way that we might receive cash from operating activities is from interest and dividend revenue from investments. Okay, and how about the cash outflows related to operating? Well, we have to create the goods, and then we have to run our business. So anytime cash is paid for operating activities, for running the business, cash paid to run the business and provide our goods to customers. I like to say operating expenses, but they don't necessarily have to be expenses under the GAAP terminology of expense. And then the other one that's not so obvious is interest. So when we pay cash interest on loans, even though this is a non-operating expense on the income statement, it is in the operating section of the statement of cash flows. And so let's take a quick look at an income statement. Here is the income statement for Starbucks, and we see here operating income, and we go a few lines down. This would be here is the non-operating section, and we see interest expense showing up in the non-operating section. And yet, when we look at the statement of cash flows, interest is going to be in the operating section. Okay, the next major section is the investing section. So the operating section can be looked at as primarily related to items on the income statement, whereas investing items are primarily related to changes in long-term assets. So we are looking down the cash receipts. How are we going to receive cash from long-term assets? Well, sales, when we sell our plant, property, and equipment, or when we sell our investment securities. We're going to record that into the investing section. Also, when we receive the principal repayment from our borrowers, when we were the lender and we lent money to somebody else, in other words, when we issue a note receivable and we collect that note receivable in cash from the borrower, we're going to record that as investing, because why did we lend to somebody else? So that we could earn the interest revenue as an investment. And on the other side, cash outflows would be for purchases of PP&E and purchases, of course, of investment securities. And also when we are lending to borrowers, we are issuing a note receivable. And then finally, the financing section generally relates to long-term debt and equity transactions. So we are referring to cash received when we issue shares of stock. Cash received when we borrow money, either as bonds payable or notes payable, when we take out the loan. And cash paid when we make any payments related to those shares of stock. The main way that the typical way of making payments to our stockholder is dividends. And let's just clarify that this is dividend payments. We saw in the operating section, dividend receipts. This in the operating section, that's when we own an investment in another company's stock and we're receiving the dividends. Here's where we're paying dividends on our stock to those outside investors. Another payment related to shares of stock is when we buy our own shares of stock back from investors. So purchases of our own shares or purchases or acquiring treasury stock. When we pay back those bonds or notes payable, those repayments is a cash outflow related to the financing section. And now let's start looking at some statement of cash flows. In class, we looked at Apple's balance sheet and income statement. Now let's look at their statement of cash flows. So again, I'm going to search SEC Edgar, and I like to do legacy. Put in the ticker symbol. I'm going to go to filing type 10K. I'm going to choose the most recent 10K. I like to choose interactive data because it gives me a nice format to view the financial statements. Once I come to this screen, I choose financial statements, and now I'm looking for the statement of cash flows. So here it is, the statement of cash flows, and we see the three sections: operating, and we have our net cash generated or provided by or received, $104 billion in the most recent year. Next, I see my investing section and the total cash used in or spent from investing activities, $14.5 billion. And then finally, in the financing section, I see cash used in or spent related to financing activities, $93 billion. Let's look at each of these in a little more detail. Now, the operating section of the statement of cash flows doesn't just show cash received from customers and then cash paid for the costs of running the business, such as buying inventory, buying supplies, paying salaries to our employees, paying for advertising. Instead, most companies report using the indirect method, where they're starting with net income and then reconciling or adjusting net income for all those items that either affected net income but did not affect cash from operating activities, or that affected cash from operating activities but was not included in net income. So we'll see all these adjustments here. We are not preparing the statement of cash flows in this course, so we don't have to worry about these adjustments. Let's just jump right down to cash from operating activities. And so what do we see? Over the 3-year period, we see cash from operating activities are increasing. This is a good sign for investors, of course. And then we can come down to look at the investing. One question we can ask is, how does the cash received from operating relate to the total cash that was spent in investing and then also in financing? So the company took in $104 billion of cash from its customers in running the business. It spent $14.5 billion investing, and it spent $93 billion in financing. This gives us a net decrease in cash. So the company spent more in financing investing than it took in from running its business by about $4 billion. And so next, let's see, what is the company investing in? I see here purchases of marketable securities. These are our debt and equity investments that we're talking about when we see the term marketable securities. Marketable meaning there's a market for it. We can easily trade it to just about anybody. That differs from these non-marketable securities. They would be have to find a specific buyer or a seller of these who's willing to sell them with us. It's not just anybody in the market. So most of our activity comes from these first 4 lines, purchases of, we bought investments. And look at these numbers over the past 3 years. The company has been buying a lot of investment securities. This is Apple. This is not a bank, but doing a lot of purchases of other companies' stocks and bonds. So we see in the most recent year purchase of $109 billion, and then proceeds from the maturities. So the stocks don't mature, so these must be maturities of bonds, either corporate bonds, governmental bonds, or a mixture of both. And then proceeds from the sales of marketable securities. So what we really want to do is look at the net amount of the purchases of the marketable securities less the cash that was received. And this nets to almost flat. This is about a $3 billion purchase cash outflow, so more investments made than sold or matured. But not a whole lot. This is about evens out. Now, the company had $11 billion of payments to buy plant, property, and equipment. And that's great. That's what we want to see from a company like Apple. They're expanding and they're making more, buy more buildings and equipment so that they can make more goods for people like us to buy. And so that's the main component of the cash used in investing activities. Now let's take a look. There is a very large cash used in financing activities. Where is this from? So I see the main number here is repurchases of common stock. This is Apple buying its own shares out of the market. So not only is it buying a lot of stocks and other investments of other companies, it's also buying its own stock. What else is happening here? $14 billion payment of dividends to the investors. So the $14 billion of dividends and the $86 billion repurchase of their own stock, treasury stock, these are all ways to give cash back to investors. What else is happening here? The company issued some long-term debt. But we see that a lot of this cash used in financing is due primarily to the purchase of the company's own stock. So what's happening? The company is receiving a lot of cash from its customers above its costs to run the business. It's doing some purchases of plant, property, and equipment, but a lot of what it's doing with that cash received from the customers is buying their own shares of stock back. Let's take a look at one more company. This is Tesla's statement of cash flows, most recent statement of cash flows. We see a lot of reconciling items, and then we see cash provided by operating activities, $11.5 billion, and we see significant increases over the 2 prior years. We see nice, large, fast growth, which is great and not terribly surprising for a company like Tesla. We see that they are using about half of the cash received from operating activities to further invest and grow the company, purchases of plant, property, and equipment. And then we come down to the financing section and see they spent about $5 billion in financing activities, and it looks like it's the net of cash received from issuing debt, so issuing bonds and taking out other types of loans, less the repayments. So this $14 billion shows as positive. This is actually a negative number. We can see that if we try to do the math here. $9 billion received from issuing debt would have to be less the 14 spent when debt was other loans were repaid, and that gets us to about the $5 billion net cash paid out in financing. So we have this $8.9 billion cash received from issuing new debt, but we paid off 14. So overall, we're taking in about 11 billion from our customers. We're spending about half of that to expand the business, plant, property, and equipment, and then the remainder of that is in repaying our debt. Now let's look at one more type of data. Here I took a data set from CompuStat database of several different companies that I was interested: Apple, Ford, Macy's, Microsoft, Netflix, Nike, Tesla, Uber, and took their cash flows as operating, investing, financing. And these are the ones that we're going to focus on here. I'm just going to look at a couple of these companies, and for each one of these companies, I pulled down 20 or more years of data. And so here I charted Apple's 3 types of cash flows: operating, investing, and financing. From 2009 into 2021, why did I start from 2009 when I pulled down the data from 2000? The reason is there wasn't much to show earlier compared to what has happened after 2009. There's a lot more variability. So this is where the exciting stuff is. We see a fantastic trend in operating cash over this period, a steady increase. And then let's look at the financing, cash from financing. So it looks like the company was staying pretty net flat, then had some net cash outflow from financing through 2017, not too big. And then we see between 2017 and 2018, we see a very, very big decrease in the cash cash from financing activities, or we can say a very large increase in the amount of cash spent in the financing section. So let's take a look at further. When we see a chart like this, we think, what happened in 2018 in those financing activities? What was all that cash spent on? And we also see an opposite trend in investing activities. Between 2018, it looks like there was we went from a net cash outflow in investing to cash inflow from investing. So did we sell some plant, property, and equipment? Did we sell some securities? What happened? What happened in 2018 and again in 2019 to give us this big cash inflow from investing? So in order to look further into this, I need to pull up I would like to say the 2019 statement of cash flows, which is also going to show the 2018 and 2017. So I can look at the trends in the investing and financing sections. So let's go back to Apple's financial statements. I'm going to go back and look at the prior year. I'm going to pull up the filing date 10/31/2019. I'm going to get the statement of cash flows. The operating section didn't show anything too surprising, so I'm going to come down to this investing section. I know that this first column here is the year ended 2019, and then of course 18 and 17 are shown next to it. And I come down to the investing activities, and I'm trying to explain for the investing activities, why did they go from a typical cash outflow from investing, right? Typically, companies are bringing in their primary source of cash is from operations. And typically they are spending, you know, it's a mature but not terribly mature, not on the decline company. They're spending in the investing section, growing the company. And what happens in the financing section, it really depends. It depends on how they are paying for these investments. So if they are financing plant, property, and equipment by issuing debt, then or stock, we're going to see cash outflow in the cash inflow in the financing section. But if they're paying for it from cash from operations, then we're going to not see much change in the financing section. So let's see with Apple, why did they have such a large, why did they go from cash outflow in the investing section to a large cash inflow in the investing section in 2019? So we see the most of the activity took place. They purchased about 40 billion of marketable securities. These are the debt and equity securities, but they also sold 40 billion and then received 57 billion in cash from these marketable securities. So they bought 40 billion, but they sold about 117 billion. That gives us a net amount that marketable securities from sales were more than the purchases by about $57 billion. So we see that investing activities increased because we sold off our stocks and bond funds. How about financing activities? We see this big decrease, a sharp decrease from financing activities. Cash, we spent a lot of cash in 2018, and we continue to spend a lot of cash in 2019. Let's take a look at what's happening in the financing section. Are we repaying loans? Are we paying more dividends? And we see neither. We are actually, most of this is coming from repurchase stock buybacks, buying our own shares, treasury stock, 67 billion of the 90 billion. And we're also paying out dividends. So we're returning a lot of cash to our investors. And similar, we saw an error on the 10K for previously for Tesla. And we see that here too, payments for dividends, these should all be shown as negative. They're obviously not receipts of dividends. A dividend receipt would be in the operating section. So these should show as negative. So that's how we've explained our large decrease in the cash from financing activities, these big cash outflows. Now let's turn to Tesla. We see not much relative between 2008 and 2013. And then we see a lot of activity happening between about 2014 through the most recent period in 2021. And what jumps out at me? So I see between 2017 and 2021, our operating cash flows increased dramatically, and that's not terribly surprising. We see Tesla's becoming more and more available over the past 4 or 5 years. So we would expect the cash from operating activities to go up. But I see a huge decrease in my financing activities between 2020 and 2021. And I also see a large decrease in the investing activities between 2019 and 2021. And so on the homework, you'll be asked to look at Tesla's statement of cash flows and choose from multiple choice options of what explains those decreases. Let's take a quick look at what we have for our homework. When you log into Blackboard and come into our course, you will see week 1 statement of cash flows, and you'll see a link to homework 1. You can expect something like this each week. And we have about 20 multiple choice questions, very straightforward. Interest expense is reported where in the income statement, where is it reported on the statement of cash flows? Some general questions related to what this video has covered, and you've covered this in other classes as well. Then you're going to take a look at Target's statement of cash flows and answer a few questions. About Target statement of cash flows, you're going to take a look at Walmart's statement of cash flows and answer some questions, basic questions there. You're going to answer a few questions that compare Target and Walmart. And then finally, as I mentioned earlier, you're going to take a look at this graph for Tesla and answer just a couple of questions about what best explains these major changes that we see in Tesla's statement of cash flows. Any questions, just shoot me an email. Otherwise, by next Saturday, you'll see the materials posted for week 2.